In this week's video, we'll review the market from numerous perspectives to help us answer the question, are stocks closer to a major top or a major bottom? In the first segment of this week's video, we're going to put last week's breadth thrust into a longer-term trend context. You may remember there were 4 previous cases where we had a very significant shift in momentum, with a similar rare shift occurring in April of 2019. We know from last week's video that long-term performance in each of the 4 historical cases was very, very satisfying. The charts that follow will help us answer this question. Are we closer to a major bottom, a bottom being the one that was made in late December, early January 2019, or are we closer in the present day to a major top? It's a weekly chart of the S&P 500, 1998 on the left side of your screen. This is the peak in 2000, and this is the 100-week moving average in blue. If you know your market history, you know we rolled over, had very, very ugly S&P 500 performance, and made the lowest low in October of 2002. We only had summation index data dating back to 1998, and our first rare breadth thrust occurred in 2003 at this point here. From a long-term perspective, really good things happened between this point A and this point B, and once again, really bad things happened in the S&P 500. The only difference was the duration of the move. It took longer to drop in this case. This was a much faster and harsher move. Our second rare breadth thrust occurred in 2009 here, rallied into the spring of 2011, and had a serious decline with a low coming in October of 2011. Similar to this low here in 2002, 2003, and similar to the low or bottoming process between 2008 and the spring of 2009, the third rare breadth thrust occurred in early 2012. And then really good things happened for a long period of time. After the peak in 2015, the market put in a low in early February 2016. And similar to this point here, and this point here, this low was followed by the rare breadth thrust or move in the summation index that we covered last week. And once again, really good things happened after the breadth thrust. The move in the S&P 500 from the date of the thrust completion to this peak here was 38.4%. The move from this major low at point A to this point B was over 200%. And the move from A1 here, the date of the completion of the thrust, to this point B here, was over 110%. Our rare plunge comes into December of 2018, and we get the fourth breadth thrust. The chart in front of us now puts last week's analysis into a longer-term context. The thrust that occurred in December of 2018, early 2019, was similar to the thrusts that occurred at a major low in 2003, a major low in 2009, near a major low in 2011, 2012, and again near a major and significant low in early 2016. And the 100-week moving average helps us understand the bigger picture probabilities relative to where we are in late April of 2019. You can see we came down and slashed below an upward sloping 100-week moving average in blue. Didn't stay below it very long and then recaptured it in a very violent and V-bottom-like manner. Once again, relatively rare. It's pretty fair to say that the present day here really doesn't look anything like this turn here, where the market came down, dropped below a flattening 100-week moving average, came back up here, retested it, and failed, and really bad things happened, and the slope rolled over. It's also fair to say the present day on the right side, upper right-hand corner of your screen, really doesn't look anything like this period here. You can make an argument that this point here is very, very similar to this point here. In each case, really bad things happened following this type of look. And the 100-week moving average helps us discern between volatility to ignore and volatility to respect on a very long-term time frame. It's more of a reference point than a timing tool. It helps us understand context. Thus, if it's fair to say the present day doesn't look like this period or this period, how does it compare to this period here? The trend is weaker here off of the low and then turns back up. This period here starts to look more like this longer-term trend here. Similar situation here. When you break through a downward sloping 100-day moving average, the probability of having a significant give back is higher. Doesn't always work that way. It's also probably fair to say that the present day slashing through an upward sloping 100-week moving average looks more like this period here, with a very brief visit below it in 1998, and probably looks more like this period here, where price slashes through an upward sloping 100-week moving average, comes back and retests it, and then moves higher. We also look a little bit more like this period here, at least relative to this point here and this point here. Have a little bit of a flatter look here, but we still have an upward bias, and eventually good things happen. So one of the morals of the story from this week's video is, in each of the 4 cases highlighted by the orange boxes, at some point following the thrust, you have a give back and consolidation period before the market moved higher. At some point following the thrust, you have a give back and a consolidation period before the market moved higher. We can say the same thing here with this orange box, and then stocks moved higher. Very, very similar situation here. When we came back up near the previous highs, we had some give back and consolidation that occurred above an upward sloping 100-week moving average. Once again, this look here, this look here, this look here, and this look here are all more favorable from a long-term probability perspective than this look here or this look here. And the 1998 case also tells us we can't assume that the consolidation box is necessarily coming now. It's possible the market could make a new all-time high, as it did here, and then push significantly higher with some of the give back coming from higher levels, telling us to keep an open mind about all outcomes, and also telling us to have realistic expectations about the market consolidating and having some type of a 4 to 10% type pullback at some point in the not too distant future. History says both cases should be respected, which aligns with the concept of taking it day by day and making decisions about the data in front of us. This is the data that matters for us today. All this simply helps with context. There are numerous ways to measure or define a breadth thrust. These thrusts shown on the screen here are based on the summation index for the NYSE composite. You might remember we also covered a very rare setup using the S&P 500's percent of stocks above the 200-day moving average. If we put these thrusts on the chart that we've been covering, you can see it aligns nicely. Similar message here, similar message here, and we had the same message here. which doesn't forecast anything about what happens in the present day. It just helps us assess odds. And it's extremely important to note this study here using the summation index used data going back to 1998. And as you can see, the thrust that we just had in the present day, does it occur here before a major peak? No. Do we get one here before a major peak? We do not. Do we have anything like this, or this inside of this red box? We do not. Do we have anything like these 4 historical cases inside of this red box? The answer, once again, is no. You can find this analysis using the percent of stocks above the 200-day moving average by Googling this title here. Now let's shift gears to another analysis. You may remember a few weeks ago we covered a very rare shift in weekly MACD using the S&P 500. It was covered in this video here. Since this analysis was done a few weeks ago, the analysis that follows is a way of following up on this analysis and extending it so we can look at probabilities walking forward from the present day. So what we're going to do, we're going to look at these 16 periods that featured the rare momentum turn using weekly MACD and take these 16 periods and see if we can learn anything using a longer-term trend context or the same 100-week moving average that we just covered in the opening segment of the video. In every single case here dating back to 1950, and there's a reason why we picked 1950. In this period back here, we have the 1929 stock market crash, the Great Depression, and World War II. If you know your economic history, you know that the economy was skewed for quite some time during the war and for several years after the war. Hence why many studies in the stock market are done in the post-war period. In each of these cases after the turn, a turn that occurred in calendar year 2019, good things happened over the next 2 years, which is reflected in this table here that we covered a few weeks ago. So now we're going to take these 16 cases and zoom in and see if there's anything that we can learn studying the same periods a little bit further down the road using the 100-week moving average. Our base study will include all 16 of these periods, and in a handful of the cases, we'll overlap some breadth thrust data. All 16 of the base cases have the weekly MACD turn that we covered a few weeks ago, which included getting 5 consecutive weekly closes above the S&P 500's MACD center line. Remember, we said we wanted to extend this study to the present day. The way that we're doing that is we used the 16 MACD cases, found the general area where the momentum turn occurred, and found the nearest point where the S&P 500 recaptured its 100-week moving average. And in the present day, it's been 14 weeks since that occurred. So in each case, we'll extend the MACD study, step out 14 weeks, and see what happened from this point historically. And then we'll overlay the breadth thrust study from January 21st, 2019, and see if that changes the data in any meaningful way. So we're going to take the 2019 chart that we just talked about, shrink it down, and it's shown on the right side of your screen. 14 weeks after clearing the 100-week moving average, this point here is similar to this point here in 1954, which means we had the rare MACD turn somewhere in here. In this case, the first close near that turn above the 100-week moving average, I believe, was here. and this counts out 14 weeks. So it might be helpful to know in each of the 16 cases what happened if we walk out 1 year. In this case, really, really good things happened. The 1957 case tells us to keep an open mind about all outcomes. From this point here, this is basically what happened over the next year. So we do not want to see the present-day S&P 500 slash through a flattening 100-week moving average. 1961 case, good things happened. 1963 case, this is a similar look here. This point here is basically this point here. Good things happened with some givebacks along the way. In the 1967 case, we did eventually come back and retest a flattish 100-week moving average. 1971 case, this would be the point that's similar to the present day. 1975, 1 year later. 1978, you can make an argument that the longer-term trend is a little weaker here relative to the present day. A little more constructive look in 1982. 1 year out, good things happened. In the 1984 case, big move, consolidation, some give back, and then gains. All of it occurs above an upward sloping 100-week moving average. 1988 case is a little bit different because we go above and below, but after that, really good things happened. 1991 case does have a similar look to the present day, and once again, big move, consolidation, big move, give back. But the trend was clearly up from a longer-term perspective. 1994, this is the point that's similar to the present day. A scare, somewhat of a retest, a recapture, and then really good things happened. 2003, weaker trend relative to the present day. 2012, you do eventually come back and retest the upward sloping 100-week. 2016, consolidate above the 100-week, and then good things happened. So if we take all of these cases, with this point being similar to this point here, and see how the stock market did from the point 14 weeks after clearing the 100-week moving average with the MACD turn here. If we look at S&P 500 performance, so this is similar to projecting April 26th forward, 10 days, all the way out to several years. The moral of the story here is we should have realistic expectations about what the next 60 days might look like. In terms of percent positive and percent negative, it's roughly a coin flip in these 16 historical cases looking out 2 months. And you can see in a handful of cases there was a fairly significant give back or drawdown. The average and median return basically flattish to downish over this period. Things start to improve a little bit looking out 3 to 6 months. In the 6-month case, 75% of the 16 cases were higher, with the average gain being 5.5% from this point here, which is similar to April 26, 2019. But the 90-day look still tells us to keep an open mind about givebacks, consolidation, and pullbacks. The good news from a probability and longer-term investment perspective is in these cases, once you got through a little bit of turbulence and normal givebacks, for the most part, really good things happened. Looking out 2 years, 100% of these 16 cases were higher, with an average gain of 25%. 365 days out from this point here historically, 93% of the cases were green, with an average gain of roughly 14%, telling us historically patience and realistic expectations in this area here was rewarded over the next 1 to 2 years. And remember, we said you can define breadth thrust using numerous tools and vehicles. The reason why we're looking at this breadth thrust analysis from January 21st, 2019 is it allowed us to go back very, very far in history. So if we look at the 16 cases that can check the January 21st breadth thrust box, remember earlier we said all 16 cases could check these boxes, but only a handful of them can check this box. And those cases are denoted here in this 10-day breadth thrust column. So how do these numbers change if we only look at the cases that can check that breadth thrust box, a very rare box? The basic message is very, very similar. We have to have realistic expectations about the next 10 to 60 days and still have realistic expectations about the next 90 to 180 days. But from a historical perspective, because the present day case can check this box, so it aligns with these 8 cases here, looking out 1 to 2 years, 100% of the cases positive, average gain 16.7% after 1 year. The average gain after 2 years was 25%. 2019 will follow its own path, and we will make decisions based on the data in the present day. This simply helps with context. And it also helps us understand that markets do not, never have, and never will go straight up. It might be helpful to know what the maximum drawdowns look like in the short run. These are S&P 500 returns from point to point. They don't tell us what happened 15 days out or 25 days out. So now we're looking at the maximum drawdown for the 8 cases that are similar to April 26, 2019. You're basically looking at the S&P 500's level on February 12, 1954, finding the lowest close over the next 30 days and calculating the drawdown. The reason why this number is the same 30, 60, 90, and 180 days out, it tells you that the lowest low was made in the first 30 days. Not the case here in 1971. The lowest low between point A and point B here was made between 90 and 180 days out. But even in this case, from a longer-term perspective, this is not a gigantic drawdown. But this table helps us keep an open mind about the real world. If we compare the cases head-to-head, all 16 cases, this is the summary portion of the table, to the 8 cases with a breadth thrust, the returns, and the percent positive and negative cases all improve as expected when we have the rare 10-day breadth thrust somewhere in close proximity to all of this. You can see all 16 cases, your average returns are negative 10 days out, negative 45 days out, and negative 60 days out. Not the case here. Nothing to write home about. But on all time frames, the average and median outcomes in these 8 cases historically were positive. And this table here reminds us that we shouldn't assume something like this, or this is coming. We should respect the fact that the probabilities are increasing that something like this, or this is coming. But it's also possible that the market could move higher and consolidate from higher levels. That's why it's extremely important to make decisions based on the data in front of us rather than any historical analysis. It's not a bad trade-off historically to ride out this type of volatility for the most part, because if you held from this point here through this volatility here, this is your reward here and here. Thus, the moral of the story is very, very similar to last week. The longer-term outlook remains favorable. Charts don't look like a major peak is coming, but the short term is becoming more vulnerable to a normal and to be expected 4 to 10% pullback. And these figures here tell us that the pullback could be very muted. It might not even hit 4%. And it may be easy to think we couldn't get muted drawdowns like this, and it's not possible to get returns like this or this, because in the present day, we just had yield curve inversion and the Fed is playing around with interest rates. Well, the analysis that we covered a few weeks ago tells us that even in a period that featured rate hikes, rate cuts, 2-10 yield curve inversion and 3-10 yield curve inversion, followed by 3 rate cuts, that good things can happen from point A to point B. And if we add this period here to the chart that we covered earlier, it helps us keep an open mind about better than expected outcomes rather than guessing or assuming that we know what's going to happen. Something that may jump off the page, it's pretty easy to make an argument that this long-term period of consolidation with our moving average jumping around, this long-term period of consolidation with our moving average jumping around, tells us that this period here is probably more like something in here following a long-term period of consolidation relative to this point here. But that's all to be determined. And just a reminder, saying that the 210 yield curve is about to invert is quite a bit different than saying it is already inverted. We could have said the yield curve is about to invert in January of 1995, just as in December of 2018, we could have said the yield curve is about to invert. We know from past videos, after saying the yield curve is about to invert, what happened in the S&P 500? This point A here is this point A here, and this is the S&P 500, and this is what happened next. In the yield curve analysis that we've covered 3 or 4 times over the past 6 to 9 months, seems to align with the data that came out on April 26, 2019. That being, we shouldn't assume that yield curve inversion, especially on the lower end of the yield curve, the shorter duration maturities, necessarily means that a recession is right around the corner. U.S. GDP in Q1 was the strongest rate of growth for the first quarter in 4 years. The charts can't predict the future, and that's why this bullet point here and this bullet point here will be extremely important as we head into next week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shravaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.